The information provided in this podcast is for general information purposes only and should not be considered as personal advice. Always consult with a qualified professional or expert in the relevant field for personalized advice tailored to your specific situation.
The client has existing insurances and they're wanting to change them. In other words, either cancel them or reduce the sums insured, all the rest of it. What I say to them is before you do any of that, go see your doctor, have a complete medical checkup and see if there's anything that comes up, anything.
That's a great
Because
point.
what ends up happening is that, again, Murphy's Law basically says that if I cancel it, what often will happen is usually within weeks or months, something happens.
Welcome to another episode of the Wealth Guide podcast brought to you by Ryker Capital. We are super excited today because we've actually got our first ever guest speaker on the podcast. So to all of our listeners and all of our viewers, I hope you're just as excited as we are. Today, we're going to be talking about a very interesting topic. And that topic is why you don't need life insurance. I'm sure most of you are going to be thrilled to find out why. But before we kick off, I'd like to just introduce the people that I've got with me today. Dr. Jeffrey Scott has joined us from MetLife. He's the head of advice strategy at MetLife and has worked in the insurance industry for over 30 years. Absolutely thrilled to introduce someone that I personally admire immensely in our industry. So over to you, Jeff, just to say hi to everybody and give us a little bit of background on you.
Hi, Jasmine, and thanks to Ryker Capital. It's been a pleasure to actually be invited here and be your first actual guest. My background is that I've been in the insurance industry for over 30 years. I'm passionate about it. And I think the reason I got into this industry was that my dad, who's a house painter, the very first job that I ever had as a kid was working for my dad. And what he effectively did was he worked me hard for 2 consecutive summers. And I realized that while I appreciate what blue collar people do, I much prefer to be in an office. And his exact words to me were, get an education. So I basically followed Dad's advice and that's what you got to see.
I think you've ticked that box.
I was going to say, how do I compete with this?
I'm not sure. Look, we would like people on our podcast that know more than us and have a lot of different perspectives to bring. So we love that. But look, it's also really awesome to have you with us today again, Ray.
Thank you, Jess.
As you all know now, Ray's the founder at Ryker Capital that really has made that all happen. He looks after all of his clients like their family, as we all do at Ryker Capital. So Ray, tell us a little bit about why you do what you do. You founded Ryker Capital. We give advice to all of our clients like their family. It's a really awesome thing to be able to do that and also to bring this podcast to the people. Why do you do what you do?
Jazz, I absolutely love adding value to people's life. And over the 17 years of doing this, the material difference that you make in people's life is substantial. By helping them, nurturing them, guiding them, and seeing them sort of come out the other end, it brings absolute joy to me.
I love that. Well, today we wanted to bring a segment to our clients that's going to be a little bit different to what they probably usually hear from people that are in the financial advice or insurance industry. And it's about why you don't need to have insurance. And Jeff's really passionate, he's got his big smile on his face over there. So I'm going to start with you. Jeff, why do clients not need insurance?
And I think first I should clarify is that if the Ryker Capital team has sat down with the clients and they've basically put the plan in place and the clients have got so much investments that they can literally live off the dividends or interest or the income coming from that, or they've got so much investments they can literally draw down on the capital and or maybe they've actually been fortunate enough to win Powerball and they don't need to work anymore, then in that case, they probably don't need insurance either. And I think that's the thing, is that where a client actually still needs to work and they rely on that income to basically support themselves and all the rest of it, then in that case, they may still need life insurance. But again, if the team at Ryker Capital have already done the job and actually have basically set the client up for life, then may not be necessary. So that's the starting point. Now, when I take a look at that, the next thing is that as people go on through their life, we know for a fact that what ended up happening is that as I get closer to retirement, hopefully I've built up plenty of retirement assets. The other thing that I've also done is I've likely also paid down all or most of my mortgage. And most importantly, the kids have hopefully grown up and moved out of the house. Now, the statistics that we're seeing from the Australian Bureau of Statistics is kids between the ages of 18 and 35, 1 in 4 of them are still at home. So they're staying a little bit longer because, well, of various other issues that we know that are happening. But again, if you ticked all those boxes, You have a large retirement nest egg. You've paid off all or most of your mortgage. Your kids are grown up and out of home, and you don't need to work to support yourself. Then you probably don't need life insurance. Again, it's worthwhile. But again, what I say to people is always talk to your financial advisor and just double check.
Look, I think those things make sense to most of us. And it's very important to look at that aspect. You don't want to deplete your savings or your superannuation savings if you don't need life insurance.
Yep.
But I do think that there are some other aspects to consider. There might be some clause in your mortgage contracts, for example. Do you want to talk a little about that?
And that's one of the things that often the biggest liability most individuals have is the mortgage they have on their principal residence, on the family home. And in many cases, what you have with many of the mortgage contracts is there is a trigger event in there that says, if we believe that you're unable to service this loan, we have the right to call the loan in and ask you to pay it in full. So often death becomes a significant situation. So you have a husband and wife or two partners who basically taken out the loan. And often one of the trigger events is if one of them passes away, then the loan is immediately payable in full. The other situation is that if I become totally and permanently disabled and I'm unable to work ever again, then that's often a trigger event as well. So what ends up happening is that if that's the case, the reason that the banks will call in the loan in that situation is that they basically believe that the person is unable to service that loan because since they have no income, they'll be unable to service the loan and make those loan repayments. And so that's often a situation that if you're in that situation, I always sit back and say, why do you need life insurance? Well, life insurance usually has two primary things that you want them to be able to do. So in general, what life insurance does is the two primary things it does in general is one, it allows you to pay off debt. Two, it creates an income stream to replace lost income or lost revenue. So ultimately, when we talk about the various types of insurance policies and all the rest of it, we keep on coming back to those same principles. Am I using this to pay off debt? Or am I using this to basically replace a lost income stream? And if the answer is I don't need to pay off debt anymore, and I already have an income stream being generated from my investments or from my rental income or from my dividends from my super fund, or I can just draw down on capital, then I may not need life insurance. But if the situation is no, I don't have enough assets yet to be able to live on that, or I know for a fact I wouldn't be able to service this debt and pay it off, then life insurance often becomes a necessary component of any wealth management strategy.
Not many people read the contracts, Jazz. When I had my mortgage, and I'm a financial planner.
Yes.
I was so excited to jump into my property that I'd go, where do I sign?
Well, German person over here, I did read every single word in my mortgage contract, and I actually did send it back twice to the lovely financial institution to change two things. But that's a really good point, Ray. And look, I was hoping that maybe you can share some stories about clients, that we've had in positions where they mightn't have been able to meet those requirements. We work with a lot of mortgage brokers in our business. Mortgage brokers refer clients to us. We refer clients to them because obviously they are experts in this field. They really do understand mortgage contracts and they read them on a regular basis. Any client stories you recall that you can share?
Sadly, Jazz, over the course of 17 years of working in financial services, there's been a number of those kind of stories. In Australia, we've got this false sense of security that, hey, Centrelink will look after me, right? If something happens to me, I'll go to the Centrelink and they will pay me a pension or they will pay me some form of a income stream and I'll use that to pay that off. Now, I do recall a scenario, this is going back about 4 years ago to be exact. Client came in saying, look, my wife's been disabled. I'd like to make some claim. I said, what I can get. Firstly, I was absolutely shocked because I did a policy not long ago. So to sort of hear that was a little bit of a shock. And once we sort of did go down the path of going to Centrelink, their mortgage was around $800,000. The repayments, I'm guesstimating here, at that point in time was about roughly 4 or 5% interest rates.
Yeah.
4%.
Yeah.
It's still $32,000. What they were going to get from Centrelink was, again, from memory, was roughly around $22,000.
And today, I looked at the most recent numbers. It's just over $27,000. So if you're a single person on Centrelink on disability support payments, you're going to get paid just over $27,000.
Yeah,
and that includes the energy support, the energy supplement, and the pension supplement. So again, maximum you're going to get for an individual who's off work from Centrelink or that is going to be just over $27,000. Now, as you rightly pointed out, Ray, if that's the case, are you going to be able to meet your mortgage payments? The answer is you're hardly going to be able to put food on the table.
Spot on. I was just going to say that. Like, that's not even going to cover my Woolies grocery bills.
No, guys, I'm doing the numbers in my head here, and I think the scenario that you've just covered here makes it clear that there is still a lot of people that do need life insurance. So not everybody will fit into the category of you don't need life insurance, because on about $20,000 or $30,000, you can hardly sustain a mortgage in Sydney.
Yeah.
Obviously, you then also have a lot of other costs. You mentioned the client's wife in that circumstance was disabled.
Yeah.
So it wasn't just about the mortgage, was it?
No. But it's also the ongoing maintenance and ongoing well-being, financial well-being of her. Now, the fact that she was disabled, she needs a disabled access ramp to her house. She needs someone that's going to be caring for her all the time. And all of these costs then just start to add up, and they put that extra financial stress not only on the individual that's surviving, but also on the person that's looking after them.
It's really heartbreaking to hear that. Mm-hmm. What I'm thinking right now in my head is about my own personal circumstances. So I'm a working mum, as you know. My husband's a stay-at-home dad with the kids. Both of our roles are vital. If either of us is unable to do their job, it would be an enormous financial burden on the family. I obviously know the Centrelink rules, and whenever I sit with clients, I always say, look, Centrelink is great. We are very blessed to have it, but I never want you to need to go there. If we go there, that's okay, but it should be part of the strategy. It shouldn't be the full answer.
And again, I think when I take a look at it, if I'm living in a rural setting and the cost of living is significantly less and the mortgage is significantly less and everything else, then Centrelink at $27,000 might be appropriate. If I'm living in one of the major capital cities across Australia, pardon my language, there's no way that's
no fluffy way.
That's going to happen. Because again, the cost of living in Sydney, when you look at groceries, when you look at electricity, you look at gas, you look at petrol, you look at mortgage payments, all that stuff added up. There's no way in the world that a person can survive in Sydney on $27,500 if you have to support a family and everything else that goes along with it, and your mortgage isn't paid off, and.
But guys, have you seen the property prices regional areas? They're almost the same as Sydney, almost. Yeah. I'm like,
no, it's catching up. People are catching on. The lifestyle in our rural areas is nothing to be ashamed of at all. I just took a family trip to Goulburn and my kids didn't want to leave. We stayed on a farm. There was animals, green grass around. I really, really loved that time. So I'm not surprised. Look, I think when you click on a podcast that says you don't need life insurance, to me that says people want to know about how they can be responsible for themselves. So, Jeff, what can you do as a person to make sure you can look after yourself?
I think the first thing is, one, sit down with your financial advisor, because there may be situations where you can't get life insurance. And again, there's often age restrictions based on when you can get in, your occupation, your health, all the rest of it. So depending on, you might not be able to get it. So sitting down with a financial advisor says, okay, what are my alternatives to be able to manage my lifestyle, manage my standard of living? So that's step one. Then step two is, what do I already have? Now, most clients, if you're part of a superannuation fund, there is a very strong likelihood that you have default death cover, and you may also have default TPD cover inside your super fund. So it isn't that you don't have anything. The thing is, what's available to you? Then the question is, sit down with a financial advisor, again, Ray, other people from the Ryker Capital team, and actually ask the question, okay, based on my current situation and what my default cover is within my super fund, what's the gap? And with that gap, then do I basically take an insurance policy out, or am I willing to basically take it and risk it? Now, when I look at the statistics, I wouldn't risk it. I'm a numbers, as you mentioned, my first degree is in mathematics. I'm not a person who likes risking it. It's just not my thing. So when I look at that kind of stuff, then the question becomes, is that what does life insurance actually do? And what it normally does is that it pays you either a lump sum amount or it pays you an ongoing income stream if a defined event occurs. So a disease, a specified disease, an injury, an illness, you're unable to work, or heaven forbid, you pass away and die. So those are the events that happens. It is not unemployment insurance. Now, I've had people say to me, oh, does it replace my income? The answer is no. But what it does do is if you're too sick or too injured or you suffer a particular medical condition, then you're normally going to get paid.
Okay.
And so the question becomes that under what conditions do you get paid? Well, then we take a look at the types of policies there are.
Well, and that makes sense because I guess if you are retrenched, even though that's a sad event and you might not have opted for that and it's not ideal, you're able-bodied to get out there, get another job.
Yep.
I think when something really unexpected and sad happens to you, that's out of your control.
Yeah.
Like an accident or an illness.
Correct.
I think that's why life insurance is tailored to that need. So just so people understand, that's the main difference in the way that life insurance companies were built and what they think about. It's an event you can't control.
Correct. And then when we take a look at what are the types of policies available, and so there's basically 4 basic types of policies. One's called death cover. And what that effectively does, people may also call it life insurance cover. So death cover, life cover, they interchange it. But effectively what it does, it pays you or your beneficiary a lump sum if you're terminally ill, so a terminal medical condition, or you die. So that's the first one. The second one is called total and permanent disability cover. And again, that pays a lump sum if due to a disease or injury or illness, you're permanently unable to work.
Okay. What do you mean by that? Give us an example, maybe.
Let's say that I was in an automobile accident, and due to that automobile accident, I basically suffered paralysis, and I was in a blue collar work where I had to use my hands and legs to work, permanently unable to do that, then that's going to pay me. So that's an example of what you see from that. Now, there are other examples, and again, Ray and the Ryker Capital team probably have a whole list of clients who've been through this in the past, but that's the type of thing that you're looking for. So am I unable to do this job due to a disease, injury, or illness, and it's going to be permanent? So I'm never going back to work. If I can't do it for a particular period of time, then we have this thing called income protection insurance. What income protection insurance does effectively pays you a monthly benefit to replace a proportion of your income. So normally it's depending on what type of policy you have, it's often either a 70% replacement ratio or a 75% replacement ratio. Now, again, there's variations of that, but it pays you that ongoing income for the time you're off work due to, again, disease, illness, injury, and it helps you replace that lost income that you're not getting from your employer anymore.
Right.
And then the last one is what's called a trauma benefit. What a trauma benefit does is if you suffer a specified medical condition, it'll pay you a lump sum. Now, you mentioned about the client who was suffering from that disability.
Yep.
If they suffered one of the, again, from these companies, there's normally about 40 defined medical conditions on these policies. The big 4, though, still make up anywhere from 70 to 90% of the claims.
Yep.
And those big 4 are severe cancers, severe heart attacks, severe strokes, and cardiac bypass surgery. So those are the big 4. And from those big 4, we normally see anywhere from 70 to 90% of all claims that come through.
Yeah.
And when you talk to most people, if you talk to most people that you, between the age of 18 and 65, and say, do you know someone who suffered one of those 4? And normally the answer is going to be yes. There's often friends or family members or work colleagues that say they have. And what that money effectively does is it allows people to make those lifestyle changes that you mentioned, Ray, about putting a ramp for
wheelchair access,
so they can get better access, and various other things as well. If they also need to do alternative therapies that's not covered by their private health insurance or it's not covered by Medicare, then allows them the access to try alternative therapies that may not be funded through various other ways. So again, it gives them that additional money to basically reassess their lifestyle and basically refocus their lifestyle on managing that illness or injury.
And I've got a very personal story about that. One of my closest mates, he is very well known in the mortgage side of the industry. He personally himself suffered a tragic disability event where he was in a car accident. We're finding more and more of that, which is car accidents. So the car sort of turned upside down and sort of landed on his neck, which has literally made him disabled from neck down.
I'm sorry to hear that.
Which again, he in his prime is in his 30s and he's got to provide for the rest of his life till age 65. And it's incredible how much of a lifestyle change and the financial impact it has on you at that point in time.
Look, I think the financial impact is becoming really clear to our viewers and our listeners because we are sitting here thinking about the mortgage repayment, the energy bills. But for us as advisors, we've got a very unique perspective on this. How do you think you could describe the impact this has had on his mental health, the mental well-being of the family?
I think it's impacted both of them severely, because not only he had to sort of firstly accept the fact that this has happened to me, and what am I going to do next? Where does my next salary comes from? Where's my next, how do I pay my bills? Because it's not only just the medical side, it's the ongoing cost of living that I've got to pay now. And then further to that, it's the family around you who are also being now financially impacted, because someone's got to stay home and look after him. Someone's got to take him to the toilet. Someone's got to dress him. Someone's got to care after him.
Yeah.
So that has had a huge financial and mental impact on him and their family.
I think one of the other things is that, again, simple maths, what's your biggest asset?
Yeah.
And most people will say, it's my car, it's my house, it's my super fund, it's my boat. And effectively, their biggest assets themselves.
Yeah.
Their ability to earn an income. And if you basically do the simple math, say, okay, I'm fresh out of university or I'm fresh out of high school, how much do I expect to earn from age 20 or 25 all the way through to age 65? And when people say, okay, well, how do I do the numbers? It's like, well, what are you earning now? And people say, oh, well, let's pick a number of, let's say $50,000 a year. So, right, $50,000 from age 25 to 65 is 40 years. And they go, yeah. I said, now let's assume no indexation, nothing fancy like that. How much is that? And people go, well, $50,000 times 40 years, that's $2 million. And I go, yeah, and that's assuming no indexation, you don't get a promotion, you're in the exact same job for the next 40 years. How likely is that? And they go, no, that's not going to happen. Yeah. I go, okay, so if that's not going to happen, then you know for a fact that your minimum earning potential over the next 40 years is going to be at least $2 million.
Yeah.
If you're on a higher salary, then that basically it's a multiplier effect. And when you sit back and say, well, would you, if you knew that your house was worth $2 million, would you insure it? And they go, of course. If you had a really fancy car that was worth $2 million, would you insure that? Yeah. And they go, without question. It's like, well, how do you think you get your house? How do you think you get your car? Well, I get that because of my ability to earn money. Well, wouldn't you want to insure that? And the answer is yeah. So, and the time you stop insuring it is when, like, you go back to the original first principles, is if I have enough assets or income from my other investments that I don't need to work anymore.
Yeah.
But if I still need to work, then I'm my biggest asset. Let's make sure that I protect that biggest asset. Yeah. And again, hopefully, I hope that you never, ever need to use it. But again, I'm one of these people that I do crazy things. I know risks and I do crazy things. And the couple crazy things I do is that I referee ice hockey for fun.
Wow.
And so so the teeth that you see in front of you now are not my originals.
We'll have to take a closer look now.
But during COVID, what I also did was I was told I needed to take a certain amount of annual leave. And I go, yeah, not a problem. And I thought, what am I going to do? Because I can't travel anywhere. So I went and got my motorcycle license. 2 weeks after I got my license, I did what many people do, and I fell off my bike.
No way.
Broke my ankle in 3 places.
Oh.
And so I now have 2 plates and 8 pins putting Humpty Dumpty back together again. But the thing that I realized was that literally in a blink of an eye, things can happen. And I'm usually quite risk averse and all the rest of that stuff. But again, basic physics, I realized that if you're leaning too far in and you're not going fast enough on a bike, basic physics say the bike is going to flop on top of your ankle. Well, it did, and it broke it.
No.
You've proven that theory.
I've proven the theory. Basic physics still works. And so again, was I doing anything irresponsible? No, I was doing everything I was supposed to, but again, things happen. And I think that's the thing, is that why do I have insurance on my life? Why do I have insurance on my house and my car and all this? Is because I hope nothing ever happens, but I know it could. And the question is that if it does, do I want to basically sell my existing assets or basically have money in my bank account that I draw down on to pay for it? Or do I want to have somebody else help me with this, with the cost associated with replacing it or repairing it or putting it back to where it was before? And that's what insurance effectively does.
Yeah.
Look, I think thinking today about whether you do or don't need life insurance, it feels really important to me to make this statement that I hear you say a lot, Ray. And that's that insurance companies are here to help us. They are here to pay claims, and they're a huge part of our financial planning strategy for clients. So, Ray, is there anyone that we've helped in the past where, though the circumstance leading to claim might have been tragic, you have been able to share with them that sort of that sigh of relief, giving them back some of the peace of mind around receiving money from the insurance company?
Yeah, absolutely, Jazz. I think the biggest one was, and the recent one was, one of my clients, the husband passed away, wife with 2 young kids, having them to bring them up to school. And again, as sad as it is, but it's also taking that financial stress away. You see their face changes, right? But the biggest impact was when you walk in with that check and you sort of help the client out to go, well, this is what it's going to provide for the next, paying off the mortgage or looking after the kids' school fees. And I think that's a big meaningful impact that you provide for the client.
What a great legacy that parent has now left for his kids.
Exactly.
Allowing that step back and said, I loved you so much that I made sure that you could just stay in the house that we had the memories in, and you just continue to go to the schools that we thought were important to you as well.
Absolutely.
And I think if that's the legacy that the parent leaves for the kids, and they sit back and say, Dad really loved us. Why? Because even though he's not here to provide for us, we know for a fact that he loved us so much that the house is now paid off, and I can just still hang out with my friends in this environment and still go to the same school.
I've got a roof and head, and I think that's the basic principle right there, right?
No, look, thanks, guys, actually to both of you for what you do. Ray, thanks for giving advice. And, thank you to the insurers for being there for us. It's a very important part of society. Now, let's just go back, though, to the people that would have clicked on this link and are listening and viewing this podcast. They're interested in finding out, why do we not need insurance? Jeff, I know that you're big on reading, and I know that you know a little bit about what's called behavioral finance.
Yes.
I'd love to get your views on, why is it so hard for us to invest in ourselves? Why is it so hard for us to give money to an insurance company?
The very simple thing is that there are 4 people that did a lot of research in this. So there's the 4 gentlemen are Thaler, Tversky, Kahneman, and Early, and they're effectively the godfathers of the research in behavioral finance. And they've taken a look at various things that people say and do, and how they react to money and how they react to risk. And often what they have is that what they discovered was that each day our brain takes in over 74 gigabytes of information. That's every day.
Wow.
But they also know, so it's an incredible computer that we have between our ears. The thing that we know, though, is that at any given time, our brain can only process 50 pieces of information at any given time. So what they do is we actually create shortcuts, or what they call heuristics. And so what those shortcuts effectively do is they sit back and say, well, I don't want to go through all this information that's bombarding my brain. So I'm going to basically park at places and do my own shortcuts with it. And so one of the things that people do with when it comes to finances is, one of the heuristics they do is they have what's called mental accounting. And some people call it the bucket strategy.
Right.
So what I do is that I've got a certain amount of money I'm putting for groceries, and a certain amount of money I'm going to put for my rent or my mortgage, a certain amount of money I'm going to put for petrol, and a certain amount, and then they've got a certain amount for entertainment and all the rest of it. And then when people go, okay, then you come along. So the Ryker Capital comes along and talks to the clients and says, I think you need to have insurance. They go, wait a minute, that's not one of my buckets.
Yeah.
So the mental accounting that they've done is they go, it's not in one of my buckets. I've not allocated for this. And so they often get defensive, saying, well, that means I've got to take money out of here. Often, if you've done a budget, most people have, let's call it excess money that they've spent on things and they don't know where the money's gone.
Yeah.
And you bring it back and say, okay, let's do the budget and see where you've actually placed the money, because they think they put it in these areas. Many cases they haven't. So often the first one is mental accounting, is one of the heuristics that they've done. One of the other things that we've seen is with regards to self-attribution, which basically means they believe that since they have never been sick or injured in the past, they're never going to be sick or injured in the future. They believe that they're better than the averages in the marketplace.
Don't I see that all the time? This is hilarious.
It won't happen to me.
Yeah.
So that's the basic self-attribution stuff. And one of the other things they have is often herd behavior. So if friends and family haven't put a focus on life insurance, then often they won't put a focus on it as well, because the people that they trust have basically said, well, insurance, who wants to have insurance? When they go, well, if people that I respect with regards to decision making, haven't done it, then why should I do it?
Yeah.
So those are some of the things that we've seen with regards to the mental accounting, the herd behavior, the self-attribution. And then what we also see is that when it comes to various biases, people have various biases. And the first one is what's called loss aversion. People go, well, loss aversion, that means you should actually want to buy insurance. And the answer is, well, no, because when you think about when you buy an insurance policy, what do you actually get? And the people that are in the industry in financial services, they go, well, we're giving the person peace of mind. And the thing is, peace of mind, people can't touch it.
Yeah.
They can't feel it. They can't play with it. They can't eat it. They look and say, you're giving me peace of mind, but what is that?
Yeah.
And so when it comes to loss aversion, what we're actually giving them is that we send them this piece of paper saying you've got a policy. And then every year we remind them that you've got to pay me money. It's called a premium.
Yeah.
And so from a loss aversion perspective, what people are saying is that you're asking me to give you money on a regular basis. And every time I give you $1 and pay this premium, it's money out of my pocket. So from a loss aversion perspective, people go, I don't like giving money and not getting anything in return. And so it often causes people this angst every time they pay a premium. And I know that I'm guilty of this as well. Whether it be my life insurance, whether it be my car insurance, whether it be my home and contents insurance, my health insurance, when I get this, I'm going, I'm paying for it, but what have I got for this? And then people say, oh, you got peace of mind, you got protection. It's like, yeah, but I can't play with it. I can't touch it. I can't feel it. I can't eat it. It's not an experience. This basically frustrates me.
Yeah.
And so that loss aversion situation is something that's built into what we do. The other thing is that people also have this status quo bias. If it ain't broke, don't fix it. So you'll ask people, do you have existing life insurance? And they go, yeah, I've got it through my super fund. You go, okay, should we review it? They go, no need to review it. Why? Because they think that what they have is enough and let's not change anything because I'm happy with what we have. Let's not change anything. So what we have is this status quo bias and this loss aversion bias often causes people to not want to purchase life insurance. So that, along with the mental accounting, in other words, doesn't fit into my buckets, often creates a series of things why people are reluctant to buy insurance unless we bring them along the journey to say, what are the statistics? Why are we doing this? Who are you doing this for? And all the other bits and pieces. So what we've done at MetLife is we know for a fact that people want to see that they're getting something for it. So we have this program called 360 Health that effectively says that you can get access to specialist doctors. You get access to a GP referral. You can get access to nutrition counseling. You get access to fitness counseling. You can get access to mental health people as well. And it's at no additional cost.
Wow.
So in other words, and you can basically, so if you have a policy with MetLife, you do not have to be on claim. You don't need to inform us. You go directly to 360 Health and they can help facilitate this. And what we realize is that once clients realize that they can get a benefit that will help out them, can help out their clients. And we know for a fact to get to see some specialist, it sometimes takes weeks or months to get through to them. Where with 360 Health, they actually help facilitate that often quicker. So people are saying, well, if I need any of those those things of assistance, I can get it and it's at no additional charge other than me paying my normal premium.
It's a great initiative to make some of that premiums tangible, if you like.
And it's something that they can use multiple times throughout the year. They don't have to be on claim. They can use it. Their spouse can use it. Their kids can use it. And for us, we thought that that's a great tangible benefit that people can use without having to actually have a claim submitted and get paid the claim.
Yep. Oh, that's wonderful.
So you might even just need the life insurance just to get access to this awesome benefit. I think one of the things that I want to congratulate all the viewers on, though, is by you guys listening or viewing this podcast, it's a matter of your personal growth as well, because understanding things like behavioral finance or biases about yourself allows you to grow as a person. So I think that's a really great first step. So maybe reflect a little bit on that, because the story that Ray and I are about to share just in conclusion of the episode of this podcast, it's quite heartbreaking, but it actually relates back to exactly what we've talked about today. Sonia is actually a client of ours that has recorded a personal testimonial for us. So we'll pop her story into the comments below so that you guys can view that. But Ray, do you want to tell us a little bit about how we've helped Sonia?
Absolutely, Jazz. And look, all I feel like I'm just playing heartbreaking stories after one after another. Look, Sonia's story was exactly along what Jeff's just mentioned. It wasn't tangible for her. So she was been paying for this income protection policy for years and years and years. And she goes, right, I just feel like I'm living to pay to just insurance companies. And I go, I completely get it, Sonia. I'm doing much the same. But I want you to sort of have that in mind because you've got the mortgages that you've got to pay. Now, should something go wrong tomorrow and you've got to look after yourself, where is the money going to come from? So this is where this story is so great because Sonia, who was just about to cancel her income protection policy, next year gets diagnosed with breast cancer.
And we had a really good relationship with Sonia, but also with her mortgage broker, Jeff. So it was a conversation between the client and the two professionals about literally putting pen to paper or scooting off that email to cancel her cover 1 year.
Yeah.
And thankfully you and Kathy were able to actually prevent Sonia from doing that.
Yeah.
Because the year after that, we got another phone call from her.
This is just another example of fantastic relationship that key people play in your life to help you, coach you, and guide you through that process. Whilst it's not a tangible benefit that you may not see, but when it comes to kind of time to claim, she got to keep that tangible asset, which was her house.
And I think the other thing is that if a client has existing insurances and they're wanting to change them, in other words, either cancel them or reduce the sums insured, all the rest of it, what I say to them is before you do any of that, go see your doctor, have a complete medical checkup, and see if there's anything that comes up in either their blood test, the urinalysis, the x-rays, anything.
That's a great point.
Because what ends up happening is that, again, Murphy's Law basically says that if I cancel it, what often will happen is usually within weeks or months, something happens.
Yeah.
And what you want to do is say to the client, let's make sure you make an informed decision here. Make sure you've got nothing that's going to show up. Make sure that you're not going to have any issues going forward. You're actually making an informed decision so that people can actually do this stuff. And the number of times where I've seen advisors say to the clients, I'm not going to do anything until you see your doctor, come back with a clean bill of health, then we'll have a discussion. And it often picks something up. And they sit back and they come back to the advisor and they say, we need to submit a claim form now because the doctor's found various issues and we have to prepare for a claim form because I'm likely going to be off work for a period of time.
Right.
So it's been one of those things that I've seen it happen far too many times. What I say to most clients is that before you do anything, talk to your advisor first. And second, talk to your medical professional, your GP, and get tested to make sure that you've got no underlying health issues.
That's a great point, Jeff. I think we've never considered asking our clients to do that. So I think it might be a great opportunity for clients to go before they cancel, get them to do a medical test. Yeah.
Look, I think in conclusion, our podcast today is about why you might not need insurance. But I think all of us need to really kind of identify with the thought process that Sonia went through. She's a single mother. She looks after disabled children through her work. So she's a teacher of kids with disabilities. But she bought a home. Okay, she put a roof over her kids' heads. And she made really smart financial decisions with the limited funds she has. I mean, most of our clients are people from normal walks of life. And she decided to invest some of that money into the family's safety and protecting the family. So if you're still thinking about whether or not you need some insurance, get some professional advice and definitely keep talking to friends and family because at the end of the day, that's why you are going to take that cover up. If you like today's episode of the podcast and if you're watching us on YouTube, please make sure that you subscribe to the channel, and maybe even place a comment below. If you're joining us on any of the other platforms, just make sure you do follow us because there's many more episodes to come and we'd love you to join us next time. Thanks so much, Ray. Thanks so much, Jeff. Have a great rest of the day.
Thanks, Jasmine.